All right, let's return now to what's really become the big story today. The Fed announced just an hour ago a $600 billion bond buy to help spark the economy. Our next guest is a former Fed governor appointed by President George Bush. He says large-scale bond purchases will be an effective tool. Randall Kroszner is an economics professor at the University of Chicago. He joins us now from our Chicago bureau. And let me just first ask you, Professor, if you found any surprises in today's announcements. It seems that the Fed was simply making this announcement based on what the market expected, a little bit more, but pretty much give or take what the market wanted.
Well, I think they really kind of created the expectations that the market had. The chairman started talking about this in August, and then a lot of different pieces on the order of $500 billion over sort of a 6 to 9 month horizon. Those ideas had come out, and so I think they largely fulfilled the expectations that they had developed.
I was able to keep Michael Aronstein here for a minute, and I wanted to have him kind of explain his reservations about what the Fed did, and then see, Randy, if you could answer that. Michael, you have a problem with sort of the communication and not exactly knowing what the Fed wants to achieve with this.
Right. I would like to see the Federal Reserve articulate kind of step by step what adding $600 billion in additional securities to their balance sheet, what it accomplishes and how. What is the mechanism by which the addition of that amount of reserves to the banking system will accomplish what are probably greater ultimate goals on the part of the Fed? And I don't think that the chairman has made that clear in his discussions. I understand what they did in the fourth quarter of 2008, which I think saved the global economy from a real meltdown. But as far as incrementally adding reserves at this point, I'm just not certain how that works.
Randy, I'd love for you to address that, because Matt and I've had a lot of guests on who kind of expressed a similar concern that they don't get what does this really do for the economy, bottom line. This doesn't create jobs, which is our big problem. What does it do except create a lot more liquidity out in the system that has all of our emerging market neighbors kind of worried over there?
Sure, no, it's a very, very important question, and what the Fed is trying to do is, or I believe what it's trying to do is a very difficult balancing act. If you see what's been happening over the last 6-9 months, the inflation rate has been coming down, whether it's the core rate stripping out the volatile food and energy sectors or the headline rate. And so the Fed is becoming concerned about the potential for inflation expectations to get very low or even turn negative and to get into a Japan-style situation. It's difficult for the chairman to talk explicitly about that because I think that may raise too many concerns. And I don't think he thinks it's a high probability, nor do I. But I see this as, in some sense, buying some insurance against that tail risk. And I think that's the main thing that it'll be doing to give people confidence that we're very unlikely to get into that scenario, that kind of Japan-style or 1930-style scenario. And then what this will do, it provides the necessary conditions for growth, that there'll be enough credit that will avoid that really bad downside. It's not sufficient. This is where the rest of Washington has to come in, and we've got to have the Congress and the administration all sit down together, work out what's going to happen on the regulatory side, work out what's going to happen on the fiscal side, because otherwise firms won't feel the confidence to be able to actually hire permanent workers rather than just temporary workers.
Michael, do you agree?
I don't see any chance of a deflation in the style of the 1930s. In fact, if we had a CPI that was based more on food costs, as is the case in a lot of the developing world, our inflation rate would probably be running at 5-7% right now. To me, the CPI is an arbitrary measure of a basket that may or may not be representative of anything. In the 30s, we had a collapse in the money supply as banks were vaporized. We had no FDIC. And so the collapse in the money supply created a shortfall in purchasing power. People couldn't afford anything. Now I look at a world, and the biggest problem the world has is there's too much money.
Randy, this seems to be kind of the crux of the argument for people who are against this. They say, hey, we're not really on the precipice. We're not on the brink. We shouldn't be so concerned about deflation. Why do you think the Fed is? I mean, is it looking simply at different measures? They obviously have good information.
No, we're looking at the measures. I can't imagine that that any reasonable CPI measure would be on the order of 5 or 6% for the U.S. Even if you look at the headline number that includes food and energy prices, those numbers have been coming down significantly because a lot of other pieces have been coming down also, even though some commodity prices are up. And I don't think it's a likely scenario. I'm not suggesting that it is, but it's a small probability of something that can be very, very costly. And I think this kind of flexible program that the Fed is putting out now will really provide that comfort that the Fed will be there to make sure we don't get into that bad scenario. Also, there are a lot of challenges on the fiscal side, and I think the Fed is worried what could happen there.